Hi, Mount Research Market Insights video for November 30th, 2023. Hey, everybody, Willie Dowich here. Glad you have tuned in. Glad you're listening. It is the end of November, November 30th. It is also a Thursday, which means it is time again for a 3 for Thursday video update. And that's what we have for you today. 3 things I want to highlight in today's video. 1, we are seeing this turn higher in the tape. When we talk about the tape, we specifically are thinking about it in terms of new highs versus new lows. We'll go into what we're seeing there, what sort of implications that has going forward, the drivers for why the tape is turning positive. After that, then we'll look at that in the context of our fear of strength model, seeing that turn bullish again, what that means from a I think more tactical perspective, a shorter term perspective, and then putting some more context around this rally we've seen. We still see some of those cyclical liquidity challenges persisting. We'll look at the tension right now between what bonds are expecting from the Fed and what the Fed has signaled in terms of rates for next year. So let's get into it. First up today, this idea that the tape is turning higher. Here we're looking at net new highs on the NYSE plus NASDAQ. So just over a month ago, mid-October, we were at the most net new lows in over a year. Turned around dramatically, turned around quickly. And now this week, we're starting to see more new highs and new lows on a consistent basis. The 10-day number, which is what we really want to focus on, has turned positive. The drivers to this is not an expansion right now in the number of stocks making new highs, but rather what we typically see at this stage is a collapse in the number of stocks making new lows. That's typically what you see. First, you get the collapse then in new lows. After that, you see an expansion in new highs. Again, we've seen it several times already this cycle. New lows have collapsed. New highs have failed to expand. And then we have these fits and starts that we've kind of talked about really over the past year, where it's been set up for sustained strength, but sustained strength hasn't been able to really build on itself. If we're going to see that after now having seen more new highs and new lows, again, we need to see that new high list actually start to expand. Either way, net new highs is bullish for the market. The tape is turning more positive. In terms of tactical models that we're looking at, our fear or strength model. Now, as a reminder, fear or strength, that's what we need to see if the market is going to be able to sustain strength. Fear, we look at the VIX in terms of it being above 28.5. Right now, it's less than half that. So certainly not fear in this market. But what we are starting to see is strength emerge. That's what we're just talking about in terms of more new highs and new lows. And just to provide some context, so go back to 1990, this fear strength model, when it's been positive, S&P's been up at a 12% annualized clip. When it's been negative, the S&P's been down at about a 6% annualized clip. So 3/4 of the time it's positive, S&P rallies. 1/4 of the time it's negative, and the S&P does not move higher. It actually moves lower. Zoom in, and that's what we're looking at here, going back to the end of July 2021. The model is still working. This isn't something that's a relic of the past that isn't useful in the current environment. You can see since the end of July 2021, so just over 2 years, the model's been positive about 40% of the time. When it's been positive, the S&P's gained over 20%. When it's been negative about 60% of the time over the past 2+ years, the S&P's lost 15%. So the model turning positive because we're seeing more new highs and new lows, that's a tailwind at a particularly bullish time, a seasonally bullish time of the year for the indexes anyway. So tactical improvement, but we need to, if we're going to build on that, we've had some periods of it, earlier this summer, again, fits and starts. If we're going to see sustained strength, then we need to see this tactical improvement lead to then cyclical improvement. And that gets into our third point. I think a lot of what's been driving the market lately has been this anticipation of the Fed finally pivoting. The problem is, go back over the past year, it's been the bond market pivoting. The Fed has persisted. The Fed has kept raising rates and still signals elevated rates higher for longer. The bond market is trying to get ahead of that. Look at the CME futures right now. The bond market's expecting by the end of next year, Fed funds rate to be around 4%. As of its September SEP, the summary of economic projections, the Fed had it at 5%. So I don't think anyone's expecting at this point the Fed to raise rates when it meets 2 weeks from now in mid-December, but we will get an update to the economic projections and a new dot plot. And so that will be the Fed's chance to provide some guidance to the bond market and by proxy to the stock market about where it sees rates heading next year. Just this past week, lots of to do about one Fed speaker talking about the potential of cutting rates, even as on the same day, there's another Fed speaker talking about the need to continue to raise rates. So lots of mixed messages from the Fed. The market's choosing to believe the dovish take. We'll see what the Fed wants to do in terms of unified messaging via its economic projections in December. But right now, we have those still, I think, liquidity issues out there. You still have most central banks are still raising rates, or their last move was to raise rates. Our BAA corporate bond yield model still suggests liquidity is a headwind for stocks. And so, yeah, we can acknowledge that the bond market is starting to look for lower yields. And if those come through, that's a tailwind for stocks. But it might be, as it has been several times over the past year plus, a false start from the bond market trying to anticipate a Fed pivot. So that's our 3 for Thursday this week. Good news from a new high, new low perspective. That's turning our tactical fear of strength model positive. But from a cyclical liquidity perspective, the market's starting to move and looking for lower yields. The Fed hasn't signaled that's sustainable. So it could be another one of these false start pivots from the market that then gets reined back in from the Fed early next year. So that's it. That's 3 for Thursday. Thanks for tuning in. We'll do this again soon. Thanks for listening. Have a great day.